Okay, welcome everybody. It is Tuesday afternoon for your optional review session, January 25th. So I like to start out and give you an opportunity to ask me any questions or put them in the chat so we can, I can answer those right away if you have a particular question. The company analysis project, you guys have uploaded your financial statements, which is fantastic. And some of you may not have, maybe have gotten a 0, and that's okay. You can resubmit your statements for full credit by tomorrow night. Okay, so this week is kind of a little interim week where you have finished chapter 3, you've done the chapter 3 homework, and you're basically spending this week doing the Monopoly project. And the idea of the Monopoly project is to bring the accounting cycle all together. All right. So I think I'm gonna close the screen, even though it's gorgeous outside. All right, let's do that. Okay. All right. So before I get started, and do you guys have any questions on the calendar at all? So if you have any questions, let me know. Okay. I just heard, we just got an email from the college president, Gary Locke, who said we will be returning to campus February 7th. Okay. So what that means is you guys have an on-campus exam scheduled for February 2nd, the 2nd of February. So I will be postponing that exam and moving it probably to the following Wednesday. So that is not official yet because I need to make sure that that works for the college. But that is my plan at this point, to move that exam out 1 week. All right. Any comments on that that you can think of, as long as I'm kind of gathering information on that? Anything? So that would be February, the 7th of February for our first exam instead of the 2nd of February. So what that would mean is we'd have to work forward. Have we figured out how special accommodations are going to work? Yes, Kate, we have, but let's talk offline on that one. So, okay. All right. So I don't have a firm date. That is just my proposed date. So I have to work out some details on that. All right. And so then chapter 3, journal entries. Do you guys have any questions on the journal entries itself? Anyone? So I went through your homework results, and it seemed like you guys did. I have the homework here. I don't have the solutions listed. But it did seem like the homework questions that were that you guys attempted more than once also had to do with the accounting cycle. So it was things like, let me scroll down here. So exercise 9, 3-9, it says journalize these transactions. So those are something, creating journal entries. Creating journal entries is something brand new for a lot of you. So that is why we pause at this point and do the Monopoly project. So stockholders invest money, we hire somebody, we buy office furniture. All of those things are things you might know about, but now we're putting it in a form of journal entries, debits and credits. Okay, so we have to really grasp that. Okay, so that's the area that. So what is crucial to memorize? So Kate, you're loading up the chat, and that's wonderful. Okay, your question is, will this postpone exam 2 or 3 as well? Well, exam 3 is finals week, so that's a hard stop. So we can't take the exam on the break. So the final exam will definitely be on March 21st. I think that's the day we have, yeah. And so the question is, do we need to postpone exam, the middle exam? I'm going to have to get back with you guys on that. What I'm doing with my on-campus class is we're going forward with the next chapter's material. And then we just schedule the exam when we'll schedule the exam. Okay. All right, so let's bring up real quick. I want to bring up chapter 3 in just, I want you to feel comfortable with this material. So, and then we'll go over to the Monopoly project again. So, all right. Can you guys see my PowerPoint right now? If so, say yes. Thank you, Colby. All right. All right, accounting. So, sorry to go up and down like that. So this whole class is we're looking at the business from the perspective of, has there been an exchange? So that's going to be kind of our test. We get all this information, but we don't book a transaction unless there's been an exchange, okay? If we determine that we have to do a journal entry, that we have to process a transaction, that is, the chapter starts off by introducing the worksheet, and then it quickly moves on to journal entries, okay? And then the communicating the financial results, well, at this point, that is your statements, okay? When you get to the project, you're going to be analyzing the statements and telling us what they mean, okay? There's a lot of steps in the accounting cycle, but it starts right here, looking at a transaction and looking at an event and determining whether it justifies a transaction, an accounting transaction. If so, we create that journal entry. We post it to something called T accounts. We make a trial balance. We're not here yet, so we're just up to here. But we did a little break at the end of chapter 3 and we said, we're going to go ahead and make statements. In chapter 4, we'll introduce a concept called adjustments. Okay. And also in chapter 4, we'll do something called closing the books. Okay. All right. So you have to have an economic event, an exchange. And we'll keep asking this test for all these transactions. Was there an exchange? Okay. And it has a dual effect. Okay, so just kind of a little review here. I know you've already done your homework, but just a quick review. So the company is Outdoors Corporation. They specialize in leading guided trips, either rafting or hiking or whatever. The company bought a 12-passenger van. So you're going to ask, was this an economic event? Was there an exchange? Were accounts affected? Was an asset affected? You've learned about assets in chapters 1 and 2. Was there an asset affected? Was there a liability affected? Stockholders' equity, revenue, or expense affected by this? So quick vote, give me a yes or no. Is this an economic exchange for outdoors? Go ahead and drop it in the chat. Was this an economic exchange? Yes, yes, okay. Yes, there was. An asset, equipment went up for outdoors. They increased their equipment account. But if they paid cash, they would have decreased another account. So you have that scale where, things are balanced, okay? Or if it bought on credit, they would say it would go into accounts payable. So dual transactions. And we're going to see that you can have events that affect 3 accounts, okay? All right. Did Outdoors discussed an upcoming rafting trip with a potential customer? Was there an economic event? Yes or no in the chat? Oh, good. You got it. No's. Okay, I want you to understand that if you were this business owner, you'd be thrilled to be discussing future rafting trips, but it's not a transaction yet because there's no exchange, okay? It's an important business event. You won't get future rafting trips if you don't discuss them with potential clients, but it's not an economic transaction, okay? Outdoors pays its gas bill. Was it an economic event? Yes, yes, yes. Okay, you guys got it. All right. Outdoors got the gasoline. They benefited. They received the gasoline. Now, gasoline isn't an asset. It's an expense. You basically use it up within a month. So there's no point unless you're buying like a 500-gallon drum of it. But we'll assume they're just filling their tank. So they bought the gasoline. It goes to gasoline expense, and they paid for it in cash. So you always have to have at least 2 accounts affected. All right. So I want to bring us back to that accounting equation, and then maybe just a little bit of drill on journal entries, and then we'll go to Monopoly if you have questions or anything else you guys want to talk about. Okay. So I told you week 1, this is the basic accounting equation. Assets equal liabilities plus stockholders' equity. But I like the expanded accounting equation. Assets equals liabilities plus stockholders' equity plus retained earnings plus revenue minus expenses minus dividends. Okay. Assets, expenses, and dividends have something in common. Liabilities, common stock, retained earnings, and revenue also have something in common. All right. So in the chapter and in my slides, I do the worksheet, and we only use the worksheet once. Okay. So I'm not sure how much we want to go over it, but I really love it as a tool for understanding transactions. Legal writing for you, it's service. The company provides total service. They do editing, they do writing, that sort of thing. They're not providing a physical, tangible product. The owner is an attorney. She has a receptionist, and she does jobs. Okay. So she herself invests 25,000 cash in exchange for common stock. Now, something that's going to just keep popping up for you is be aware of whose accounting you're doing. You are not doing Betty's accounting. You are doing legal writing for you. It's always from the perspective of the company. Okay. So from the company perspective, the company received cash. So on the worksheet, we show cash goes up. If it were a negative, I'd put a minus sign, or I'd put parentheses around it, which is accounting for negative. As a company, we have stockholders. The company has one stockholder, Betty, and the common stock account went up. Okay. Now see this equation here, I've sort of expanded it to add accounts. So we got assets equals liabilities. I've only got one there. And all the others are under the stockholders' equity, common stock, retained earnings, revenue, expense, dividends. Okay. All right. Of course, when the company has money, they have to spend it. So they run out and spend $6,000 on new computers and printers. So every row here has to balance. So in our first row, we had 25,000 on the asset side, 25,000 on the other side. That balanced. In our second row, we had an asset cash that went down and an asset equipment that went up. So these two add up to 0. So that balances. We didn't have any action on the other side. So we had a 0 on the other side, and we had a 0 on the left side. Okay. They purchased 1,300 of computer paper and other office supplies expected to last several months. So it's going to last for more than 1 month, so we don't expense it. We don't call it supplies expense, we call it supplies. And we'll talk more about that in chapter 4, but it has a longer life. Okay. However, they're going to pay this bill in 30 days. So cash didn't go down. So we increase the supplies account, but now we're on that right side of the equation, and we're increasing a liability, accounts payable. Okay, every line has to balance. All right. So we go through all these transactions. I'm not going to walk through every one. And we get to the bottom, we total each item, and then we total the assets, and we total the liabilities and stockholders' equity, and it balances. Okay. So we use this worksheet to kind of get students up to speed on transactions and how they work. All right. So do you guys have any questions on the worksheet? So pretty straightforward. It's a nice tool. I like using it. As soon as we use it, we say, okay, we're done with the worksheet, and now we go to journal entries, but it gets students into understanding that double entry. Okay. All right. So where we're headed is, will the worksheet be on the quiz, exam, or is it just a tool to understand transactions? I use it as a tool, Kate. I think it's in your homework as well. All right. Actually, to be perfectly honest, some companies don't use debits and credits. They use the worksheet. My husband does, he's a teacher, but in the summer he does consulting work, and he only has like, I don't know, 80 hours of work for the whole year. He just does it to keep his hand in his field, which is land surveying. So he has a worksheet. He has 5 clients, and that's it. That's his accounting record. He doesn't need a big fancy accounting software package. But so it depends how big you are. But most companies have hundreds and hundreds of accounts. Okay. So here's that worksheet again. All right. So what in the world is a T account? Can somebody take themselves off mute and tell me what is a T account, and how many do we have to have? So what is a T account and how many do we have to have? What is a T account and how many do we have to have? And I won't even ask you why we have them. If you don't know, put I don't know in the chat.
I could take a crack at it.
Or how about if you don't want to talk, put I'm quiet today in the chat. That's fine too. So we have to have T accounts as a graphical way to understand accounting. And inside the accounting software system, there are no T accounts. But I got to tell you, accountants use T accounts all the time. Everybody likes graphics. It's just an easier way to learn. And the T accounts give us that. So for every account that we have, in this example, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 accounts. If that were all we had at a company, we would have 12 T accounts, all right? So you need 1 T account per actual account. And you post your journal entries on the T accounts. You show debits on the left and credits on the right. Oh my God, you're right, Beza. I can't hear the other students because I turned, can you hear me? I can't believe I did this. You must be able to hear me. All right. Are you guys out there? Can you hear me now? Oh my God, I should have put my headset on. All right. Tell me about T accounts. I'm talking to the empty room. Tell me about T accounts. Aaron, go ahead.
Okay, so if I understand correctly, every actual account has its own T account within it. And you have to have a debit and a credit recorded. Technically, it's either taking or adding from one or the other. And each of them have to balance when you record it.
Exactly. Well, each T account doesn't have to balance. So we'll talk about that.
Okay. Thank you.
They look like they have to balance. By the way, big thank you to Beza. Really appreciate that. Okay. All right. So we're going to have family living with us for a while, and I thought I should probably get used to at least wearing a headset, but apparently I'm not used to it yet, but we'll work on it. So the T accounts track, first you do journal entries, which we haven't done yet, and then we put them on the T accounts. That's called posting. Okay. If we debited cash, we would put the dollar amount here. If we credited cash, we put the dollar amount here. At the end of the day, the T account does not have to balance. It doesn't have to have an equal number of debits and credits, but the trial balance does. All right, so let's go over that a little more. So we track each transaction. Debits must equal credits, but not on the T account. All the debits that you posted on all the T accounts have to equal all the credits on all the T accounts, but not for an individual account. Okay. All right. All right. So now back to this equation, assets equals liabilities plus stockholders' equity. I'm just showing them both here, plus revenue minus expenses minus dividends. Okay. So we've just used that equation to create the worksheet, and now we're going to show it as the rules of debit and credit. Okay. So if each account has a rule, so the asset accounts are increased by debiting them. So if you want to increase cash, you debit it. If you want to decrease cash, you credit it. If you want to increase equipment, you debit it. If you want to decrease equipment, like you sold it or you retired it, you credit it. Okay. So I've got kind of color coded here, the debits in black. Expenses are also increased with a debit, and so are dividends. So that's why these three have something in common. Okay. So in other words, let's say you have a gasoline expense. You paid for gas. You increase gasoline expense with a debit, you decrease cash with a credit. Okay. Now these guys are increased with a credit. Okay. And these are sample accounts. So for example, if you sold a rafting trip for 10 people for $1,000 and they paid you in cash, you would increase cash with a debit, and you would increase revenue, service revenue, with a credit. Okay. So it's a little bit kind of a, why aren't the rules the same for all the accounts? This is double entry accounting. It was created by an Italian in the 15th, 14th, 16th century. Can't remember, Paolo, somebody. And it actually really works. What it does is it creates an audit trail for all of our business transactions. Okay. So assume a company has a beginning balance of $100,000 in its cash account. It then buys a car for $20,000 and it pays in cash. So did cash increase or decrease? Decrease, and therefore that's a credit. Okay. But we also have to account for the car. Did equipment increase or decrease? Equipment increased. So we debit the equipment account, yes, Aaron, and credit the cash account. Okay, so there would be that. And if you're following along in your course pack, there's a spot where you can record that. Okay. So then remember your beginning balance is 100. So when we see BB, that means beginning balance. And if we were to post that one journal entry, we debit the equipment account and credit cash. The debits and credits for cash do not balance. It has more in the debit column than the credit column. So that means you take the difference and you put the answer in the debit column. The equipment account only has a debit, so its total is going to be 20. Okay. All right. So let's say the same company buys supplies on credit. Did cash increase or decrease? That's a trick question. Did cash increase or decrease? Neither. Yes, because cash is not involved. Everything's time sensitive. And so at this point, the company has received the supplies and it will pay the bill in the future. So thinking about that exchange transaction, you're saying the company got supplies. What's the other half of that exchange? the company owes money. So you got two accounts involved. Okay. So the two accounts involved are supplies and accounts payable. Supplies went up, so we're going to debit supplies. And we're going to credit accounts payable. Accounts payable increased. It went up. So think about it from the point of view of the company. They have increased their liabilities. They owe more money. They have $2,000 more debt, which they must pay off in a month. So here's supplies. We debit supplies and we credit accounts payable. Later on, when we pay that bill, we're going to debit accounts payable and credit cash. Okay. All right. So let's go on. Finally, there, I had it there. I jumped the gun. That's good. Debit accounts payable, credit cash. Okay. All right. So there are 13 journal entries in this chapter. All right. By the end of Accounting 201, you'll know pretty much 60 accounts, close to 60 accounts. And I forget, I think it's like, how many journal entries? I wrote them down. So it's like 13. I want to say it's like 50 journal entries by the time we're done. So I would strongly recommend that you get yourself some flashcards, put the question on one side and the journal entry on the other, and just really drill on these, because it takes a while to learn this stuff. You can learn it intellectually, but you want to be able to learn it a little bit faster for test taking. Okay. All right. So lots of accounts, and we're going to, when you start the Monopoly, I give you a list of accounts to use. You don't have to use any other accounts than the ones I give you, but this kind of gives you an idea of what accounts to use. Okay. So we did a couple of journal entries. Emerald City was formed with 75,000 for 75,000 $1 shares of common stock, $1 par value common stock. Okay. So you are going to, whenever a company starts up, this is going to be its first journal entry, because you don't start a company without a bank account. So your first transaction is the stockholders invest in the company and then they have ownership of the company. Okay. But the company says, hey, the company's cash position has increased, so we debit it. Common stock has also increased, so we credit it. So how does that relate to Monopoly? Well, every Monopoly game you start out with $1,500. So you're going to debit cash, $1,500 for the company, credit common stock for the company. Okay. And prepaid rent, the company pays for rent in advance. Now, this is a new account for you guys, but you probably have personal experience where if you've gone into an apartment, you've had to pay the first and the last month's rent. Okay. So think about an asset. An asset has future value. This prepaid rent has future value, just like your last month's rent on your apartment has future value. If you decide to leave the apartment, you don't have to pay your last month's rent, which is sort of nice, although it does tie up your cash. So we're going to debit that asset, prepaid rent, and credit cash. Okay. So I'm not going to walk through all of these. Some of these are, and you're going to have transactions that are no entry. They ordered something, but it hasn't been shipped, hasn't been received. Okay. They purchased a computer. This is one that you should be aware of. Emerald City purchased computer equipment costing $5,600. So they got the computer for $5,600. They put down $2,000 cash, and they're going to pay the rest off the next month. So now this is called a compound journal entry, where you have 3 accounts or more. Okay. You put the equipment in at full value, and then you say, this is how we paid for it. And of course, in the future month, you're going to debit accounts payable and credit cash. Okay, now we got the art supplies. We didn't just order them. All right. So any questions on these journal entries? So we take out a note. I do want to talk about the note. We take out a note payable at 12% interest. Again, this is time sensitive. When this happens, on the day you borrow the money, you do not owe interest. You'll owe interest as time goes by, but right now we don't owe interest. So the company just increases cash with a debit and recognizes their liability with a credit. All right, so we paid some bills, debit accounts payable, credit cash. And I know I'm going fast, but I want to spend some time on Monopoly. Finally, this company, Transaction 8, they make a sale. They create an advertisement for an auto repair shop. It runs in the newspaper and they are paid $1,300 cash. So debit cash, we increased cash and we increased service revenue. How do we increase the revenue accounts? With a credit. All right, so here's another type of transaction. What happens when a customer prepays you? Well, we know that cash goes up when a customer pays. But what's the other account? And that's a new account called unearned revenue. That means the customer has prepaid and the company owes Joe's Organic Groceries design work for the next month. Kate, can you elaborate on that question on the $5,000? Are you talking about the note?
Yeah, I think it was the notes payable one because it said like 12% interest. I was wondering where the 5,000 number came from.
Oh, did I not have the dollar amount there? That would have been helpful. That was my error. Takes out a, you have to read my mind. How about that? Do that and yeah, I would have had to give that to you. So that was my error. Okay, good question. All right. All right, so this one, this prepayment. Okay, I need you to pause and just consider this account for a second. In our list of accounts, under revenue, we had service revenue. Unearned revenue is not a revenue account. It is a liability account. So what makes it a liability? So the company received $900, but they have an obligation. They owe service. So liabilities can be for money that you owe, like accounts payable, or it can be service that you owe. Okay. Next month, when they perform that service, they deliver that design work, we're going to do an adjusting journal entry to recognize the revenue, but that's chapter 4. For now, just know that when a customer prepays you, it's a debit to cash and a credit to unearned revenue. Okay. So here's the other example. They perform the service, they provide the design posters, and Genki Sushi says, bill us. And they say, sure, for $4,700, we're going to send you a bill, also called an invoice. And then Genki Sushi will pay them in the normal 30-day period. Okay. So we have a debit to accounts receivable. We increased accounts receivable and we increased our service revenue, even though Emerald City has not been paid because they provided the service. So let's talk about that exchange. The exchange is Emerald City provided the service, and now Genki Sushi owes them the money. So Emerald City can recognize the money owed, and we do that through accounts receivable. Are you guys hungry for sushi? I'm always hungry for sushi. Okay. Emerald City graphic designers paid its administrative assistant for a week. No, for 4 weeks. Okay. $3,600. Okay. Debit, salary and wage expense, credit cash. We never pay our employees in cash, but I wanted to give you an example of the transactions that would normally happen in a month. Emerald City receives but does not pay the telephone bill for $250. That bill is to cover service provided in January. is there an exchange in this transaction? Was there an exchange? Do they have to, is this going to be a no entry or is this going to be a journal entry? What do you guys think? If this were a test question, would you make a journal entry or would you say no entry? Beza, you are correct. What would be the other side to that journal entry? So let's think about that. Emerald City Designers gets a telephone bill. Okay. It's going to be telephone expense and accounts payable. They owe the money. So what's the exchange? Emerald City got coverage for their telephone line and they owe the money. So they didn't pay it, but they owe the money. And finally, they do a dividend, and that one's pretty easy, debit dividends and credit cash. Okay. All right. So now I got confused by the bill is for services provided. It was, oh, yes. Yes, Kate. Good, good. Let's go back. Kate is saying the bill is for service provided in January. That's the same language we used for customers. Okay, let's go back. Here we say the service will be provided next month. We created an ad, that we're paid. So as a company, let's go back to this. As a company, so think of the company as a box in the middle, okay? And then think of your customers on one side. They're a different box, and that's going to be where you have accounts receivable. But you also, on the other side, you have your suppliers and your vendors, and they're the people that the company pays. The customers pay you, the company pays the vendors and suppliers. So the customers are going to be paying, and if they don't pay right away, you use accounts receivable. The vendors and suppliers, of whom the telephone company is one of them, AT&T or T-Mobile, whatever. So if you don't pay the bill right away, it's going to be accounts payable. And so the vendor can provide service and the company can provide service to the customer. So the language is just saying that it happened. So when you see service provided, don't always assume it's a sale. But that's a very good comment, because there's so many, it's all about the language. Okay, so posting all these entries, we would have all these T accounts. Now, I like to see numbers by the T accounts. So like transaction 1, 75,000. And then over here in common stock, we've got, I think I've got it on a second page, 75,000. Okay. And that's where we need things to balance. So transaction 1, the debit and the credit have to balance. Transaction 2, cash went down $4,400, prepaid rent went up $4,400. Okay, so just be mindful of that. So we post all of these and then we calculate our ending balances. If the debits are more than the credits, the ending balance goes on the debit side. Down here in accounts payable, the credits are more than the debit, so the balance goes on the credit side. So going back to the rules of debit and credit, you expect the asset accounts to have a debit balance at the end of when you add up their T accounts, and they do. Okay. The liability accounts, no matter what, you expect their ending balance to be either 0 or a credit balance, and you see that here. Dividends has a normal debit balance. Service revenue has a normal credit balance. Salaries expense, telephone expense have a normal debit balance. And that word normal means the side of the T account that increases that account. And then finally, you create a trial balance. And here it is, and it's just the ending balance. So a mistake that students often do is they'll say, well, the total debits were this and the total credits were that. I don't want the debit and credit. I just want one or the other. I don't need the individual balances. I need the net, the ending balance. And you can see the debits and the credits balance down here, okay? All right, and that ends chapter 3. That was really fast. I'm gonna stop this